Good afternoon, ladies and gentlemen, and welcome to the ESSENSYS final results investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question in the box beneath and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and, where appropriate, publish responses. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll. I'd now like to hand over to Mark Furness, CEO, and Alan Pepper, CFO of ESSENSYS. Good afternoon.
Thanks, Mark, and good afternoon, everyone. Welcome to our FY20 results presentation. Just want to cover briefly the headlines of our business. So we are a software and technology provider to the flexible workspace industry. That industry is a fast-growing part of the real estate industry, and is responding really to the changes in the way occupiers want to use and consume space, primarily office space. It's now a world where flexibility, agility, and responsiveness is really critical, never more so than current climate. And so our technology, our software, allows the operation of these spaces. It allows our customers to use our platforms, connect and operate, to help solve the complex operational challenges of these spaces. Think about these as, if you like, hotels for business. And so high transaction volumes, lots of activity, being able to deliver services on demand to the occupiers within is critical. And our software and technology enables that. So you can run these spaces much more efficiently, use automation to increase your operational effectiveness, as well as your engagement with clients, as well as deliver those services, technology, IT services, on demand and with very little manual intervention or overhead. So that's briefly our business, 14 years now. So this is 2006 we founded the business. And so now I'm just going to cover our FY20 highlights. We were asked during our IPO roadshows about the resilience of our business. And FY20 is the perfect example of what would happen in a downturn, as the question was posed. And the reality is we proved the quality, the resilience, the strength of our business in our underlying performance. So 9% revenue growth at the top line this year. More importantly, 19% recurring revenue growth year on year. And so 86% of our revenues now are recurring. We have always focused on efficient, profitable growth, and that's come through in our 19% EBITDA margin again this year. So highlights are, strong, resilient performance of the business. We have for some time now really focused our expansion efforts on the fast-growing US property market, and we've had great success there again this year. And really that's allowed us to, in the last 12 months, accelerate our go-to-market investment to match the size and scale of the opportunity. This year, in light of COVID, we completed a £7 million fundraise, and we sit here today debt-free with a significant cash balance, so we can take advantage of the opportunities the industry presents ahead. And that industry is accelerating rapidly. I think COVID-19, for all the terrible impact it's had on many people and many lives, we actually, as a business and ESSENSYS, will see a net positive to the market opportunity due to how people think about the future of work and how they think about where and how they work, and how businesses react to that, and also how the real estate industry at large reacts to that change in occupier demand. And also through the year, some significant operational highlights, and we've continued to acquire new customers, new logos. High-value strategic customers have been joining us again this year, which is really the key part of our strategy, so that we build momentum in those high-value accounts that give us long-term opportunity, and that's a great foundation to compound for in the future. And those customers have also seen us and taken us into new territories, so new customer wins in Canada, in the Asia Pacific region, and across mainland Europe. And so a fairly straightforward go-to-market strategy. It's land, it's expand with customers. So they expand in terms of taking new products, of which we've launched 2 this year. Expanded in terms of their reach and their growth. So these flexible workspace businesses, as they obviously increase in scale and size and footprint, we've expanded with them. And to support that, this year we've ramped up our investment in R&D. So post-IPO, it was a key part of the fundraise at that point, was to really ramp investment in our products and our services. And that ramping is completed this year, and that's really starting to pull through now in the deliverables when it comes to our software. We continue to grow, so US sales headcount this year has increased 75% year over year. Highly efficient sales process and a sales team in the business, and we've increased that footprint. Across the whole of the US, we've actually increased now our reach. And so not only do we have our East Coast and West Coast offices in New York and Los Angeles, we also have feet on the street in Canada and also in the southern regions in Dallas. And finally, the change of the real estate landscape. So, the involvement in the world of the world's biggest real estate companies and landlords in the flex workspace industry has meant that we've had to develop and increase our reach into that traditional landlord arena. So we've been working hard to make sure that our brand is developed and continues to develop with that audience. And that's really pulled through in terms of the successes we've had with those major customer wins in terms of what will provide us that future opportunity and future pipeline. It goes without saying, obviously, that COVID-19 will be one of the most memorable parts of 20 for all the wrong reasons. And we saw the impact of that firsthand as the lockdown really began to take hold. And what did that mean for our business? Well, obviously, we saw some extended sales cycles in our Connect marketplace, which is an element of our services which are consumption-based. And we saw a moderation of those revenues slightly as some occupancy changes happened in these spaces. And also, we look to help where possible any short-term support to our customer base, as you would expect. So, as those things happened and the lockdown started to take hold, both in the UK and the US, we took some timely and pretty decisive action to make sure we were suitably responding to the seriousness of the situation. And that meant that, from our business point of view, we delayed or we stopped any non-essential CapEx spend or development spend or operational spend, whether that be including recruitment as well. So senior team also took significant salary reductions, and where there was any operational overcapacity in the business caused by the downstream effects of COVID-19, we took steps to reduce that operational capacity by reducing working hours and also looking to change those the way we did things to support home working and much more flexible approach to people. Now, we took those steps and they were the right things to do, but obviously we've started to see a recovery happen in both our customer base and in the market at large. And you can see actually our platforms give us amazing visibility into the occupancy of these locations, so our customer locations, and to really be able to see what's happening with amazing, really high resolution through the lens of our software. And so you can see that our business, our customers, their occupancy has been tracking back up over time. So our spaces, our customer spaces are roughly around mid-40s in terms of how much percent they are occupied right now. And we see that trend continuing over time. This year, so we've really ramped up some of the product development and new product capability, which has been timely and also has very much and are very much of the moment in terms of the impact for our customers in terms of COVID. And just as we sit here now, we've seen new business activity really recover now to about 3/4 of the levels it was pre-COVID in H1 of this year. And so increasingly optimistic for the outlook, and increasingly optimistic for the future of both of our new sales and our customers. So I'm going to hand over now to Alan, who will take us through the numbers. Thanks, Alan.
Thanks, Mark, and good afternoon, everybody. So I'll do just cover off some of the key financial highlights and touch some product split and then some KPIs in a moment. So as Mark said at the outset, pleased with the overall outcome for the year, with revenue up at 9%, so from 20.6 million in 2019 to 22.5. Our recurring revenue run rate, which is the key metric that we measure future growth by, was 19.7 million at the end of July. That's the annualized recurring revenue for July. That was up by 2.4 million from 2019, so up 14%. I'll touch on the product split in a moment. And EBITDA for the year at 4.2 million was in line with last year, and as we sort of set out our expectations for FY20, this being the first full year of ESSENSYS being listed and intended, along with next year, to be investment years as we grow capacity in the business, and I'll touch on a key element of that in a moment. 86% of revenue is recurring, as Mark mentioned. That's up 7 percentage points from last year, and that's gone through into increases in gross margin, higher proportion of higher revenue, higher margin recurring revenue driving that increase. Recurring revenue gross margin down very slightly, and that's driven by the split of the business between the US and the UK, and the increasing proportion of our business that is driven out of the US. Currently, US now 46% of the business, will be up to 50% and more through 2021. Net retention for the year 100%, so that's the revenue we got from our customers in July, the customers we had in July 19, the revenue we got from them in 2020, which is very positive in the current environment. And then the final thing really to highlight there in terms of those statistics, increased UK-based development resource as we rebalanced our software development activities from an offshore-based scheme that we had set up prior to the IPO onto with a more agile UK-based. We retain the offshore development capability to provide support and industrialization, but it means that we've got more agility in terms of product development. Mark will talk to a specific example of that in a moment. Just covering off finally on margins, UK margins continue to grow up. Lower margins currently in the US, driven by a sort of mix of sub-products within Connect primarily, but we would expect over time, and have seen, and we would expect over time, US margins to increase towards the UK level. In terms of the individual product splits, Connect accounts for 92% of our overall revenue, and there's an element of non-recurring site establishment charges, and which I'll highlight in a moment, which part of that. We continue to add customers throughout 2020 and sites. Key metric for us is Connect sites. We added 35 new Connect sites in the second half of 2020. 100% net retention again for Connect customers throughout the year, and that margin movement, as I say a moment ago, driven by reduction or mix of UK to US business. Operate a smaller proportion of the overall business, but nevertheless a good proportionate revenue increase, and that revenue increase is driven by a strategy that we've been employing for the last 2 to 3 years to actively manage the customer base of that business towards our more target customers that across the group serve higher value, multi-site, ambitious scaling customers, and that's driven that pricing growth. That process came to an end primarily with our existing customer base throughout the second half of 2020, and that's with a final customer that was in a much lower value category, which we stopped dealing with throughout the second half, and that accounts for more than the reduction in sites. That increase in revenue and values, therefore driving margin increases on operate as well. And notwithstanding those changes in sites, 101% retention, so growing the revenue with our existing customers through the year as well. In terms of some specifics, so the P&L here, I've touched on most of this. I'll just highlight that sort of revenue mix there. So Connect recurring, 17.5 million. The Connect non-recurring element of our revenue, that is site establishment charges as we set up new Connect sites. And then the operate revenue, therefore, up 500,000 from 1.4 to 1.9 million last year. We've talked through various other statistics and elements that we've highlighted there already. The only other thing that I would highlight at this point, in terms of the EBITDA being in line with last year, when we IPO'd, we were building capacity for growth in the business. That building of capacity has carried on through 2020 as was originally planned, particularly with investment in go-to-market. I've highlighted also some dev growth. So that's the driver for the overhead movement through the year. In terms of cash flow side of things, business was cash flow working capital neutral through 2020. In 2019, the business, the 2019 versus 2018, the business had a significant growth, particularly in the second half of 19 compared to what it had been in 18, and that resulted in that working capital outflow. This year, though, we've maintained neutrality. A couple of other things to highlight on the cash flow terms is our amount of our software development expenditure. So we invested 2.3 million in software development, and we'd anticipate that continuing for the next couple of years as we accelerate our product development activities post IPO and into the next couple of years. We continue to invest in expanding the geographical reach of our Connect, the infrastructure that sits behind Connect. So that's most of the £1 million. That's with additional data center capacity in Toronto, Seattle, and Dallas primarily. Final element to highlight on the cash flow is the impact of the £7 million fundraise that we undertook in April. So that was obviously there was an element of COVID-related contingency we were looking for, but the vast bulk of that was raised with the intention of investing further in growth of the business across APAC and Europe, and Mark will cover those in a second as part of the strategy element. What that means is that we ended up the year with the balance sheet substantially strengthened over the previous year and £8.5 million in the bank. Nothing particularly to highlight on the balance sheet. It's there for completeness. In terms of KPIs, just to highlight a couple that we track. So Connect sites is obviously our key KPI, and you can see those on the various announcements. So we ended up in 2020 at 419 Connect sites. That's 30% compound growth rate over the last 5 years. We have 47 contracted sites as we speak today, which means we've got a medium-term outlook of 466 Connect sites. Lifetime value of customers to customer acquisition cost was 5.6 through the year 2020. That's down from last year and down from the half year. That level, being a measure of our sales efficiency, is actually very high, and we'd expect that to continue to come down over the next year as we make continued investment in our sales and marketing capability. Mark will touch on that a bit in a moment. We have our business and our products are inherently of benefit to large scaling multi-site customers, and we have therefore a number of customers that are significant. The top three account for 37% of the business. That is down from IPO, it was about 45, and full year 19 where it was 41. And we continue to see larger customers growing within the balance of that top 10, both in the UK and the US, and therefore reducing that concentration in the top 3 and top 5. Increasingly, we see cross-sell across both our products, both Connect and Operate. About half, if not slightly more now, half of customers will take both products, and that's particularly true in the newer, broader corporate real estate and landlord entrance into the market, where we're providing them with a complete technology solution for running their flexible workspace solutions. And that's it from me, Mark. It's over to you.
Thanks, Alan. So I'm going to touch a little bit about the development of the market and in particular the total size of the opportunity and how excited we are about how that looks as we look out. And so the world of commercial real estate and the world of the office has changed massively over the last decade. And undoubtedly, if you will, the idea of onerous, burdensome, long-term leases and commitments for broadly empty boxes that take hundreds of thousands, if not millions of pounds to fit out, is one which is becoming less and less appealing over time to pretty much everyone. And so the rise of space as a service models is really led by demand side drivers. So that is really what the new demand default is from occupiers. And that's really, started to surface in a number of different ways. So, we always knew about Regus, IWG. We saw the rise of WeWork. But increasingly, what you're seeing now is the response from landlords and the commercial real estate industry at large, who are developing and delivering their own products and services so that they can support their occupier base from cradle to grave. They can provide all of the real estate products and services that are needed in the lifetime and life cycle of a company. And so you're seeing many different types of space. And that trend was growing. Undoubtedly, that would take time to pull through the real estate industry as it looked to change and respond. But COVID-19 has been a major catalyst event for that transformation, because actually now we're all used to a new way of working. Today, this is not unusual. We are coming to you via video link, the rise of Zoom, different tools, remote working, the rise of actually people wanting to be in the office. So I'm seeing that across the piece with our teams across the UK and the US. I think we were asked a question as sort of what does occupancy normally look like based on the fact that, it's running at about 40% again across all of our customer bases. And occupancy, undoubtedly, COVID will lead to some de-densification of the space. So, people won't be crammed in and there'll be more space, actual space for people. And so we see the space requirements stay the same, but obviously less people per square foot. So hopefully for Alistair, that answers the question about how it compares to pre-COVID levels. With the evolve, I guess the rapid evolution of the industry, it means we're very confident about our outlook in terms of opportunity size and scale. And I think, we've heard before, but the stat that I most refer to is that the research points to 30% of all commercial real estate globally will be consumed flexibly by the year 2030. So, and that's from today, a market which is broadly about 2% of all real estate is consumed flexibly. So it's such a growing part of the real estate industry. It's huge. And that really plays to our focus in terms of our routes to market. And so we, for a number of years now, have really been concentrating on developing relationships and customers that are strategic, that are future, that long-term high-value opportunities across 4 key persona types in the industry. So the first is the low or the very capex light, if you like, franchise type operations. And we saw this model evolve in the hotel industry originally. And so you're starting to see that replicate across the flexible workspace industry. And we've been working with 2 significant franchise operations in the US, and they've been really fundamental to our recent successes in the US. As well as the franchise operations, there's the traditional flex workspace providers. They're standalone providers. They may, their scale, so they may have 20, 30, or 100 locations. But really, they're looking to scale, they're looking to build real estate platforms, but they're really doing it separate from the landlords, other than the fact that they're taking space within those buildings. And then you've got probably the most active part of the industry right now in terms of speed of response and also size of opportunity. So you have the landlords themselves, the asset owners, and you have the asset operators, if you like. So the asset operators being, if you like, property management firms and, the world's biggest commercial real estate firms globally, people like JLL and Cushman and Wakefield, are really becoming much more active in that. And we worked hard to win those customers over the recent years to really make sure at the top of the value chain we were having success, but also to give us a real foundation so that we can compound those relationships with new logos over time and really build and increase velocity in terms of our customer acquisition. And I think, those customers today, they represent about 10 billion square feet of commercial real estate footprint. Now, if 30% of that real estate over time, and it might be 10 years, it might be 15, 20, but if 30% of that becomes a flexible product, for us, that's a huge opportunity. So on average, we see roughly every square foot is probably worth $1 or £1 of software revenue per year for us. So significant opportunity just in the customer base we have today, massive expansion for us in future. And I think someone was asking about sales cycles. So how's the sales process changed? How have sales cycles evolved during the pandemic? And we're all evolving. We respond to things in front of us. And so our sales teams, our marketing, our messaging, and videos involve more. Sales cycles are a little less efficient. I think that's fair for every business in B2B. But nonetheless, we've still closed big deals. So we've just closed a global framework agreement, one of the big global real estate companies. And whilst that's early stages of that relationship, we see massive opportunity with those guys ahead. So hopefully that also covers the sales cycles. I think that question came in from Nick. Just moving on then, in terms of from the market opportunity, we've got to develop and deliver products that meet the requirements and solve real problems for our clients, and also, if you like, makes our capability compelling. So this year, we've been working hard to develop new capability that really met the requirements of the slightly different audience that is the landlord and the commercial real estate audience. So we developed our proposition Step, which is our wrapped up capability. So it's the connect and operate technologies of our core platforms, and wrapped up in a way which is much more aligned with the requirements of landlords in the real estate industry at large. So it's based on a price per square foot model. It scales as they scale their flex footprint, and it's really designed to appeal to those buyers. And we've had amazing success already with that, and we're seeing pipeline grow rapidly. And we launched that product in the middle of summer, and we've actually already won the first contracts with Step as we sit here today. So very excited about the future of that part of our business. And also across summer, we launched a product called Smart Access. And you may sit there and think, oh, it's access control. We can all get into a building and tap our cards to get in to a door. That is absolutely right. And for many years, there's been great access solutions for the enterprise and for also buildings at large. But the world of flexible workspaces, flexible real estate, is very different. You have lots of coming and goings. This is lots of real-time requirements. So I need to book a space, I need to get into a space, I need to book a meeting room and get into a meeting room in real time. This is about taking friction out of that journey and about making and delivering immediacy. And we couldn't find a product, and our customers couldn't find a product that really suited that requirement. And so we set off and to build that ourselves. And we've actually launched that product in less than 12 months from ideation to delivery and first customer contracts. That's a significant bolt-on to our capability. It's a new module and has significant revenue upside. And obviously, in the current climate, anything that's touchless, anything that's contactless, has massive relevance in the current world we are in. And so, new product capability with developing new markets and new revenue opportunities. And post IPO, obviously, one of the key investment decisions we made was to really take the two platforms that exist today, Operate and Connect, and to develop them into a single unified capability, one which was much more modular, so had much lower barriers to entry for our customers, so they could take those modules, became best of breed. And not only would we significantly increase the value of those products to our customers because they're really focused, but also that would also increase the revenue opportunity as we could make and increase the number of modules and amount of capability. And obviously, if we can increase value to customers and ROI, then obviously you have an opportunity to increase revenue and price. And so we are barreling ahead with the delivery of the Flex Services platform. We are on track, on budget, and on time to deliver the first capability in 2021. So exciting times for product. But this all looks really good on PowerPoint and on the slides. What I've learned in 14 years of running ESSENSYS is that really it's only what you do that counts. And so our focus on strategy execution is, if you like, tighter than ever. And that pulls through in some of the successes and how we see things in the major markets we operate in. So North America this year, this is a business that last year grew 45% year-on-year recurring revenue growth. And that's not from a small business. It's not from tiny numbers. That's an established business and growing rapidly. So that business, as it's evolved, we've been able to invest in increased sales capacity. So more headcount, so 75% increase in headcount. But as we've been able to attract higher quality people, so that increases quota, reduces sales cycles, and also gives us more capacity. So an overall increase in sales capacity in the US of 84% in the year. And also that means our business in the US and North America can support us recruiting a focused in-region CEO to lead the charge across that market. That's a market with 11 billion square feet of office space. And so that is a significant opportunity over the next 3, 5, 10, 15, 20 years for ESSENSYS. And so we are deep in process for the recruitment of our North American CEO, and hopefully in the months ahead we'll have some good news and be able to announce the person who's going to lead that charge for us. So US, great success, continues, and also more importantly, I guess, besides the opportunity behind it, and we're very early in that journey. In the UK and Europe, as we were clear at IPO, our focus was really spinning up the US business. And so now, as we built that team and the leadership team to take that forward, we've been able to think about how we scale out in Europe. So as part of use of proceeds from our raise earlier this year, we're going to build our pan-European capability and presence. So that means we've identified and appointed a European sales director who will be building our European sales team and sales capability in the months ahead. And that means that we're expecting and we're seeing actually that momentum build across developing pipeline, new customer engagements, customer wins. And so we're excited to see where the European opportunity takes us. And the platform, the product is all ready. It's all built. It's native, it's ready, it's localized, if you like. So all we need to do is a little bit of translation work, and that's ready to go in those European markets. So again, more opportunity and more expansion chances for us in terms of Europe. And finally is the APAC region. So the Asia Pacific region is one that's really starting to embrace flexible workspace. And so you see landlord responses, but also you see our customers, our global customers, becoming more active in those regions and those markets. And so they're pulling us and looking to take us into those markets where we currently don't have all of our services. And so as we think about it, obviously we've had there is some restrictions on travel and some logistical challenges to make sure to sort of as we think about how quickly we can get into the market. But we certainly see the second half of this year will be when we'll complete the big push, recruit a regional CEO for the APAC region and build that go-to-market, i.e. that sales and marketing capacity in those countries to really drive pipeline and sales. And so we expect to see those first customers probably at the start of our next financial year. And actually, they're fertile markets. We have customer relationships because of our Operate platform in those markets today. And the pipeline is developing well already for our full market entry later this year. And so just to bring us to a close is really about what does the outlook look like and how do we see the future. This year we've answered a major question. So what happens in a downturn? Our strong, resilient performance, the quality of our customers, and the underlying performance of the business and growth continuing, 19% recurring revenue growth year on year, gives us that strong platform. But it's also, perhaps more importantly, about the size of the opportunity. So we made great progress this year in the US. So reaches, a geographic reach across the US continues, and our sort of our beefed up capability and our leadership team pushing across the US later this year with the new CEO will sees us very optimistic for the future of the North American business. And that's against the backdrop of really significant change in the real estate industry. Flex becoming a much higher percentage in terms of its adoption across the wider real estate market, and that trend is continuing. And you know, I would have hoped not to have COVID-19 here at all, but it is going to be a net driver of growth of our industry in the months and years ahead. And we've already seen that. So the quality and the size of the logo we've been attracting and we're now working with means that those strategic accounts, those customers we already have, provide us with significant runway, great pipeline visibility and long-term opportunity. And our job is to build products and to deliver great services to those customers to make sure that we stay with them for the whole journey. And finally, you know, it's about making sure we've got everything in place. So you know, we are debt-free, strong balance sheet, you know, significant amounts of cash on hand. We're developed fully in our key markets of Europe and the US. We're proving how efficient we are when it comes to sales and marketing activities with that high lifetime value to customer acquisition cost ratio. And so the things that are in our control are all now looking really positive for the future of our business. And our job continues mostly to be not to cock it up. So we're going to focus, we're going to stay hungry and ambitious, and hopefully you'll come on the journey with us if you're not already. I'm going to just cover a couple of final questions before I hand back, because I can see them here, that I can see on the board. We mentioned sales cycle. I think I covered that. We talked about occupancy visibility. Abby's asking, who would you say our major competitors are and what differentiates us when attracting new customers? I think, Abby, that the market is evolving. You know, we were 14 years ago, we entered the market and it was very nascent. It was a tiny part of real estate. And so we built ourselves, we've embedded ourselves in the market and solved the problems of the industry. And so today, most of our competition has entered the market in the last few years. That means they're subscale, some are pre-revenue. And obviously we have a bit of a head start and advantage. And in the years before, you know, no one really understood there was an option for an industry-specific software platform to help them. So many parts of the flex workspace industry actually try to use horizontal platforms. So use Salesforce or some of these ERP platforms and try and sort of mix and match them together to try and develop something that worked for them. That's changing, obviously. Now people are looking for best of breed solutions. And today, you know, by most markers, we are the market leader. Still very small, obviously, but we hope that continues long term. So hopefully that covers a little bit about competition. Alan, I think there's a couple of questions that you can cover in terms of recurring revenue cash flows.
So Nick's asked the question, what's the contract term cash flows for recurring revenue? So a couple of elements to that in terms of how we contract with customers. The Connect is a 3-year contract on average, and operates a 1 year. And in terms of how that works, we bill on a monthly basis for the service in the month. So on a recurring revenue basis, that's month by month for either 3 years or 12 months. Clearly, churn is very low, and therefore we've got a very high success rate for recontract elements. Hopefully, I think that answers Nick's question. I want to deal with the others.
Yeah, I think one of the questions comes in from Alistair is, you know, we've only recently listed on the UK, but recognizing that fact and that we've got significant opportunity in the footprint of the US business, are we considering a dual listing in the US? Well, we're proud to be a British success story. We think that will, that is our focus. And I think what we're focusing on absolutely is making sure that we get on and run the business and build the opportunity. And I'm sure I'm expecting fully the business to be fully valued in the fullness of time by the UK market. As a significant shareholder myself, obviously, I'm absolutely aligned with that requirement. But we'll always assess our opportunities. But in the near term, no, we're not considering a dual listing in the US.
It's probably also, I'd say, Mark, obviously, as we go forward, with developing a European and APAC business. Business will become much more global over the next 2 to 5 years.
Yeah, and another one from Alistair coming about how the development function split between Vietnam and the UK. Sort of how does that work? I think these are well-trodden paths now, outsourcing. But all of for us, if you like, getting to MVP, so minimum viable product, really prototyping, all of that's done in-house in London within sort of, I think, a couple of 100 feet of me either way in this office. And that's important for the speed of delivery. It's all about being agile and being able to respond quickly. A lot of the heavy lifting, once we've completed and committed the code, is done, and the maintenance work is done offshore. And that's always worked well for us. I think as we've been able to, post-IPO, attract more, a better quality of talent. It's a very competitive world for software developers. But as we've grown and we've got a built brand and been able to attract that talent, we've been able to obviously rebalance and make sure that the center of our development universe is right at the heart of our business, and that's working really well for us. And long may it continue. Just before, I think I've got a couple of questions that came in pre this. I think, Alan, you've got a couple to cover, but I'll cover the first two. First question is, can you provide more detail on the type of new products and services you're looking to launch? Now, we talked a little bit about the products we've launched and products and services. But obviously, our job is to make sure we are continuing to add value for our clients. And so, problems that we solve are real world problems for our industry. And there are things around how certain parts of infrastructure, sensors, IoT technologies, how all of those products, all those things are orchestrated, and how the connection between them all are automated. That's going to be important to us. How we then surface all of that data and make it meaningful in terms of actionable insight. And we want to do that and try and create some autonomy in the platforms to give the platforms making decisions. So when I think about the future, I think of surfacing that data to make sure that our customers can make better, faster decisions, and doing it in such a way whereas if can be, some of those decisions are taken autonomously to get our customers better answers. So we're always looking to push on product and development, and we will continue to do so. Great business is normally built on great products. And the further question is, you state the group's further geographic expansion is being planned and will be rolled out when market conditions are ready. Could you provide an overview of how COVID depending you see this playing out? Are there any new locations of interest? I think we've covered that earlier on. Those key markets of North America, Europe, and APAC are going to be critical to us. But having said that, we are seeing customer pull into other regions, and we are everything's ready for us to efficiently enter new markets should the opportunity present itself. But I'm sure you can hear by my northern tones, I'm quite focused on return on investment, and that will always be our primary concern. Alan, do you want to cover the?
Yeah, we've got two final ones, I think. I think these are the two final questions. So what's the split between recurring and contracted revenue? So clearly there's an overlap between the two. We touched on, so 86% of revenue, total revenue is recurring, and all of that, about 90% is actually contracted. So that should probably get with that. And then final one is, what's the view on the payment of the dividend? I think when we listed the business, inevitably this was a conversation piece for people. We are in our growth and investment mode. I think there is a long-term desire to pay a dividend, not least because the major shareholder is also on this call. But I don't think that's going to happen for probably 2 to 3 years at the earliest.
Perfect.
That's it.
Thank you very much indeed, Mark and Alan, for updating investors today. Obviously, you've taken on board the pre-submitted questions. You've addressed all the questions that have come in by investors. Should any others come through as we're closing up, obviously we'll make those available to you also. Mark, perhaps I could just ask you just to wrap up, and then what I'd like to do is redirect investors to give feedback. I know that will be particularly useful to you as a company, and I'll do that after you've wrapped up.
Great, thanks, Mark. Yeah, so thank you everyone for taking the time to meet with us, albeit virtually and via a one-way video today. Hopefully at some point in the future we'll get to meet in real life. I think our opportunity is something that we've built over the last 14 years, and primarily it's been down to commitment, the hard work and the focus of the team and our people. But our ambition is undimmed and the opportunity is bigger than it's ever been. And our job is to execute against that, and everything else, if you like, the market should take care of price, and to Alan's point, should take care of me as the largest investor. So thank you all for your time. I'd like to say thanks to Mark and the team at Investor Meet Company. I think it's a great platform, unbelievably usable and user-friendly. So we're really excited by the platform and what it can do in terms of extending our reach going forward. So thank you all. Stay safe. Have a good day.
That's brilliant. Thank you ever so much indeed, Mark, and thank you, Alan. Could I please ask investors not to close this session, as you'll be now automatically redirected for the opportunity to provide your feedback. If you access this meeting from our website, then the feedback page will appear. And if you access this via the link sent you by email, you'll simply be asked to log in and submit your feedback. On behalf of the management team at ESSENSYS, I'd like to thank you very much for attending today's presentation. That now concludes today's session. Good afternoon to you all.